Bitcoin tapped a new all-time high at 123K and has been ranging for about 2 weeks in a mild consolidation. Meanwhile, major altcoins like Ethereum have pulled back 10%, Solana 15%, and XRP over 20% from their highs. A lot of people are questioning whether the crypto market will continue its upward trend or enter a deeper correction phase. In this video, I'm going to break down the psychology of both retail and the market makers with surgical precision. And what you're about to see isn't opinion, it's strategy. So pay attention because every second matters. What's good, y'all? This is your guy JC, and I know it's been a while since the last upload. I mentioned it on my YouTube community post. I took some time off with my family for a short vacation, and honestly, with price going sideways, there wasn't even much new to say on video. So I nailed 123K top on Bitcoin, and when I dropped the Ethereum video, the price was around 3,100. I think the insights are pretty valuable. So let's get straight to the point. The crypto market has pulled back from its peak and is now seeing a slight rebound. Many are wondering, will the uptrend continue, or is this just a fake bounce before we slip back into another downtrend? Let me give it to you straight. Congratulations, we're heading up. Let me walk you through it with the kind of elite trader logic you won't hear anywhere else. So Bitcoin topped out at 123K, and since then we've been stuck in a boring 2-week range. But we have to ask why. Is it just taking a breather after a strong run? That's what your average guy would say. If you ask your neighbor Bobby why Bitcoin's going sideways, he'll probably say something like, "Oh, we're just cooling off after going up so much." That's not an analysis. Everybody can say that. Remember, we're not average. As top level traders, we look deeper into psychology, structure, and what the market makers are actually doing. Okay, let's think about it. From 98K low to 123K high, Bitcoin went straight up. You think that was retail buying? No way. That rally was clearly driven by institutions and the big players. And at that time, we had headlines like the Elon-Trump conflict, fears of US intervention in the Middle East war, all bearish narratives. Retail was scared and market makers knew it. They used their fear to launch the price vertically. Then, as always, retail FOMO kicked in and they just simply jumped on after. So now what do they want? Simple. They want to shake off as many retail as possible before the next push. And that's how they create fuel for the next one. Now the real question is, do they benefit more from a full-blown dump to reaccumulate lower, or from dragging price through a mild pullback and sideways range until everyone loses patience and sells? And I lean towards the latter. And here's why. And reason number one is the excellent macro conditions. First, let's talk about spot ETF inflow data. So if you've been watching my videos, you know I've been all over the spot ETF flow data. So when the numbers on the right are black, means net inflows, red numbers, net outflows. And we had consistent net inflows until one 3-day stretch of outflows. But in the last 2 days, inflows resumed, back in black. Ethereum ETFs, still flowing in strong, no slowing down. So what does that tell us? It tells us that institutions are buying spot while shorting futures to suppress price, not to crush it, but first to keep stacking, and second to wear out the impatient. The broader macro environment is also incredibly supportive. The recent passed Genius Act is obviously a huge win for the crypto market. That goes without saying. Global M2 continues to expand steadily, and even rate cuts from the US Fed are expected in the second half of the year. So nothing to worry about on the macro side. Let's dive into retail psychology, which is the second reason. So Bitcoin broke above the previous all-time high first, then altcoins followed. Typical bull market behavior. While Bitcoin went through a mild correction and moved sideways, altcoins dropped much harder. Even major ones like ETH, Sol, XRP saw 10 to 20% drops. Now, if altcoins had kept rising while Bitcoin was consolidating, I might have started leaning bearish. But the fact that altcoins dropped hard, that actually gave me a bullish signal. Why? You gotta ask this question, because where do you think retail holds more coins? Bitcoin or altcoins. Most retail traders don't even understand the fundamentals of Bitcoin. They're just here to make money. That's perfectly fine. But it means that they'll buy whatever looks like it's pumping hardest. That's why retail is always overweight in altcoins. Just look around. How many people do you know that don't even hold Bitcoin at all? Retail loves altcoin parties. And when retail money, especially leveraged positions, piles into altcoins, the market makers intentionally push the price down to absorb the liquidity. And even if the market is headed higher in the long run, they clean up first. Now some might say, retail got burned on altcoins earlier this year, so they probably avoided altcoins this time. No. Human nature doesn't change. As soon as they see bigger pumps on random altcoins, they'll rush back in like moths to a flame. So no, nothing new here. So Bitcoin went up, altcoins pumped harder, then crashed harder. That's the shakeout. And in my view, that shakeout is very close to being done, which means the next leg up could begin at any moment. And if there's more shakeout to come, we might get one or two more whipsaws, of course. And that applies to both Bitcoin and altcoins. But of course, the magnitude will differ. The logic behind this whipsaws is simple. So this year, May, Bitcoin topped out at 112K and began consolidating with the mild pullback. And a lot of people thought this 102K was the local bottom and assumed the rally was back on. But then came a whipsaw that dragged the price down to 98K before the real rally kicked off. No surprise, a classic retail flush right here. Because when price moves up cleanly without a shakeout, open interest stays elevated and that actually limits upside. But when they trigger a whipsaw first, flush out those positions and the future market resets. And that makes it easier for them to push price higher with much less resistance. And the third reason, and the most important one, is the market maker's psychology. Let's go back to when Bitcoin was still down low. Remember the video where I said breaking this 110.6K level would ignite a strong rally? Look at the level again. It was a major resistance zone, and that made it an ideal area for long entries. Imagine we suddenly dump all the way back there. Why would this happen? Institutions and whales bought already. You think they're going to hand retail another perfect long entry? Not likely. Also, they already spent massive capital pushing price from 98K to 123K. Zoom out even further. From 74K to 112K, price railed 50%. Then we saw a 12% correction back to 98K. And from there, another 25% move up to 123K. So now ask yourself, if they plan to keep pushing the crypto market higher, which I believe they do, why would they crash price after already spending so much to move it and hand the best entry again? From 74 to 112, 50% surge. And a pullback to 98K was 12% correction, and 98K to 123K pump plus 25%. So from 123K, more than a 10% drop would be irrational. At least not if this bull market is still in play. And of course, markets aren't always rational. And that's why we always plan for invalidation. So what's the next play here? If we were to break below 110K and eventually even risk losing the 100K level, that shouldn't be seen as mere whipsaw. It should be recognized as a potential crisis, one that could lead to a much deeper correction. So what's the ideal entry and where do we place our stop? The hint is in my last Bitcoin analysis video. Let me play for you. 2. If and only if we get a pullback down to the halfway zone of the third bullish candle, it's a prime zone to start scaling in. So in terms of price, a good range for starting your entries would be around 114. And as I mentioned earlier, you can set your stop loss at the open of the third bullish candle, which is around 111K. So I'll start scaling around 114K. My stop is when 111K gets taken out. That also aligns with the 10% pullback from the top. And recently, the price dipped as low as 104.7K, but it never actually filled. And some might say, what if price runs without giving that entry? So what? No loss, no stress. I'll hold on to all my positions including spot. I'll analyze again and wait for the next buy zone. And if I do enter and end up hitting the stop, we're talking about less than 3% drawdown. Pretty solid risk and reward ratio. So to wrap up today's video, macro conditions remain bullish. Institutions are still buying, ETF inflows are back, Genius Act approval is locked in, rate cuts are expected later this year, global M2 is rising, the bull market is far from over. And two, a lot of retail traders who rushed into altcoins during the recent surge just got wiped out and their leverage positions completely flushed. So Bitcoin's market cap has grown significantly compared to the past. Now the institutions and even nations are involved. We're not likely to see those deep corrections and sharp V-shaped recoveries as often as we used to. That's why in this bull market, retail is baited into altcoins so market makers can absorb liquidity without crashing Bitcoin itself. Lastly, they pushed Bitcoin from 74 to 123 using massive capital. They have no reason to send it all the way back down. At most, we might see a whipsaw to 114 to 111K. It's still possible, and if 111K breaks, cut it. It's less than a 3% loss. If it keeps going up from here without a whipsaw, perfectly fine. There's nothing to lose. We're still in this game. Either way, we are prepared, and that's the difference between luck and strategy. And if this video gave you clarity, don't forget to like and subscribe. That's what keeps this channel alive. Stay sharp, catch you in the next one.